Welcome to this week's live ASX strategy session. Thanks for joining me for another show. Great having you with me. Heaps to talk about this week. Movement down in the ASX, movement up in gold. Lots of interesting things going on. And also we want to have a look at your stock codes as well. So any stocks you'd like me to have a look at, bring up the charts, talk about the structure, get those ticker codes ready. We'll go through those in the second half of the show. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. Well, we've had a big volatile breakdown in the ASX 200. Is it as bad as it seems? I'll discuss that in a moment, and I'll show you an area of particular risk to be aware of. And then over in the US, bearishness is increasing, but does the price action warrant the present negativity? I'm going to show you what a key indicator just did and what it could mean. I'll get to that a little bit later. But before we do that, let's start with this latest price action in the ASX 200. Last week we were discussing tentative signs of the dip being booked, prices reaching their lows and then starting to edge higher. But instead of the follow through buying that we needed to really start to see that come into action, we've instead had a sharp break to the downside. Friday's breakdown ends one of the bullish possibilities that I've been discussing, and that was that prices were trading in a big sideways trading range above the moving averages. And we've been discussing the possibility that, so we've got the August high that would have this sideways movement into the averages, and we'd discuss the possibility that that could have set the platform for a bullish breakout, possibly similar to sort of price action we saw back in mid 2024, where prices went sideways into the averages, and then we had the break. Some volatility included with that, of course, but nonetheless a range, a break, and then high prices. Of course, that's not going to play out this time because we have a break to the downside. Prices are now trading on key support. We discussed this level around 8,600 last week. It takes in a previous all-time high from February, and also a secondary peak in June, had some support, kicked in around July, and now here we are again. The other notable change is that the ASX 200 is below its 100-day moving average. I've got the 50-day above that, and then the 100-day. And this is the first time the ASX 200 has really been below there since back over here in late April, early May. There were a couple of little excursions below there last week, but this is the first time it's really had a notable move below the 100-day since back then. It feels like there's been an element of panic to the last 24 hours, as evidenced by this sharp decline. But is such a hasty exit from the market justified? And at this stage, I just don't think it is. Let's unpack what we have at the moment. So first we've got this break below the 100-day moving average that we just discussed. So this in itself is not a bearish signal. The key now will be how the price action develops now that it's below the 100-day moving average. So is it a short but sharp push below the average, like we saw, like we could say, like look at this one back from August 24, from a high, short, sharp move below the averages, and then a quick rebound. Could we get something like that, or is it more of a lackluster bounce where prices can't really make a great deal of headway, and we kind of stall below the moving averages? It's the lackluster bounce. This would be the scenario that would concern me, because that would open a window of vulnerability and then potentially lead to that structural shift in the market. And that's where prices shift from trading above rising moving averages where the dips are bought, to then potentially being below moving averages which start to decline, and then we get in a situation where the rallies are sold, and then from a shallow bounce we end up with another push to the downside. This is a scenario of, I think, of most concern, and that's the one to look out for. But we don't know yet. We need to see how this price action develops. At this stage, I'd say the break below the moving averages is a bit like an orange warning flag. For me, this means being alert. It means knowing where your exit levels are on your stocks. Like always, planning in advance. Okay, if things go bad, where do I get out? But then also not panicking. We get a down day. It looks ugly, but as I've seen in the past, you can get a few negative days that then quickly reverse. We just don't know at this stage. Need more information. So for me, it's the not panic stage. It should never be the panic stage either, by that matter. It's like knowing your plan, knowing your rules, and following them. That's really the best way to avoid panic. Coming over to the equal weight, let's have a look at the ASX 200 on an equal weight basis, and I think the equal weight provides an important part of the picture. Look at this week's price action. It's still trading above its low from last Friday. So this tells us that while the broader market is pulling back, well, we can see the ASX 200 is pulling back. It at this stage is telling us that as far as the broader market is concerned with the equal weight, it's pulling back, but it's really just that. It's just a pullback within potentially a rising trend back to the moving averages, which is a normal part of a rising trend. You get these trends, they pull back to the averages and they consolidate and they potentially rally again. So at this point, the equal weight is not giving a great deal of cause for concern. So why are we seeing so much more weakness in the ASX 200? And I think a big reason for that is due to selling in the banks, or in particular, selling in CBA. And you can see that come through in the financials index. So let's have a quick look at the financials. So this is the ASX 200 financials index. And I've been discussing in recent weeks how this appeared to be setting up for a bullish break. That's what I thought. I thought we had this sideways trading along rising moving averages, and that was a precursor to a push higher. We started to get a push higher, but we didn't get the follow-through buying. It's come back to the averages. Now we have that quick decline. We also had this series of rising lows, which is also usually another positive factor. And it's like factors like this, like rising moving averages, rising lows. These are all factors that can shift the odds in favour of a bullish outcome, but odds are about probability, not certainty. And we now have a break to the downside in the financials, just as we do the ASX 200. It's too early, I think, at this stage to say whether this is a more lasting turn or simply maybe part of a longer consolidation after a long bullish phase. This has been a strong and long bullish phase in the financials, as it has the ASX 200. I think how prices respond now they're below the moving averages, I think that will tell us a lot. Just like I was going through at the ASX 200, do we get the shallow bounce that stalls below the moving averages? And if we were to get that, that is the like I was saying with the ASX 200. If that next rally does stall below the moving averages, and the rebound was then stall and then rebound is then sold, well, that's a sort of structural shift that can then lead to longer lasting corrections. We don't have that at the moment. It's a risk point to be watching. Coming back to the, and of course, this has a big impact on the ASX 200 because the financials are such a large part of it. So it's important to keep a close eye on that at this point. Coming back to the ASX 200, all we have at the moment is a 5% pullback from an all-time high. We've seen similar pullbacks over the last 18 months. So just look at there's this pullback in around December last year. There's a similar one from July we mentioned earlier. There's another one from March last year. They're all around that 5-6% mark, not dissimilar to what we have now. And in those cases, prices return to new highs within a few weeks or months. So that remains entirely possible now. Yes, there are risks to monitor, as I was going through with like how the structure is below the moving averages, what the financials do, how they structure. But until we have clear signs of a trend change, which we don't have at this point, I'm happy to stay long stocks and manage my risk with those trailing stops that we always talk about. We've had just remember, we've had a strong, largely uninterrupted run in recent months. The latest pullback, well, look, I think this latest pullback, it's a reminder that it's rarely one-way traffic, although you might have forgotten that over the last few months because it almost has been. But it's not. It's not one-way traffic. And pullbacks they're part of the game of the stock market. The key, I think, is managing the pullbacks in a way where we protect our capital and then also avoid unnecessary panic. And that's the sort of thing we talk about through these strategy sessions and through the motion trader mentoring reports and all of that. Okay, so let's jump over to the US. Before we do that, just quickly, if you're getting some value, please click that like button, leave a short comment, tell me what you think. What do you think? Do you think we're in for a bigger pullback, or is this going to be short-lived? What do you think's going on? It's always interesting to see what you think and what others are assessing from this situation. And click that like button. Helps me heaps. Tells YouTube that people watch what I do and listen to it and get something out of it. And then YouTube shows other people, and that makes it all possible to make this stuff continue on. So do that, please. Click that like button now while you're thinking about it. All right, S&P 500 next. What I'm finding fascinating here is how quickly bearish sentiment appears to switch on. All it seems to take is one or two down days, and people start looking for a big sell-off. And what makes it more unusual is that stocks, they're only a couple of percent off their all-time highs, and that's not what we often see. Bearishness is typically associated with lines below the moving averages. When prices are below the moving averages and they continue below there for a while, bearishness typically really picks up then. So much when prices are at all-time highs, you don't usually see big surges in bearish sentiment. I'll come back to sentiment in a moment and show you a graph to put the current situation into some perspective. But before we do that, let's look at the chart structure that we have here. I think the key feature remains these rising moving averages. The 50 and 100-day moving averages continue to trend upwards. That's been the case since back here in May. And if you look at the moving averages, they haven't, look closely at them. You'll see that they haven't even started to flatten out, let alone turn down. And the most important factor is that price remains above the moving averages. So that meets the criteria for a bullish trend. Now, people will point out that they go, yeah, well, look, that's all well and good, but this condition is also true prior to pullbacks. And, well, that's true. For example, let's go back to 2022, and you come back to 2022 and you can see rising moving averages, prices above the moving averages, but that was the top. Prices then started to come back, and it was a lasting top, went on for 18 months or so. So, as I say, that also met that bullish criteria. So a bullish structure doesn't mean prices have to keep rising, but I think it puts the odds in favour of higher prices. And this is an important thing to understand. It's not about certainty, as I said when we're talking about the ASX. It's about probability. It's about where are the odds? What do they favour? When prices are above moving averages, they favour higher prices. So yes, the market could top like it did in 2022, but more often than not, a bullish structure tends to lead to more highs with mild pullbacks along the way. So just look at this, like all this time, rising moving averages, prices making new highs above moving averages. Yes, there are pullbacks, but the pullbacks are mild, they're relatively short. And some of them maybe 5%, maybe touch below the 100-day moving average, but that general trend stays up, often for some time. So yeah, that's what we have at the moment. We've got I think the odds favour the bullish trend. It will end at some point. Maybe it's now, but as I say with probability, probability doesn't give us certainty, but it just helps us know, well, do what's been working. That tends to be the path of least resistance, and I think that remains the case in the S&P 500. As you can see, this is it, but it could just be more of what we've seen already. As it stands, we've got to pull back to the 50-day moving average. We have a rebound off it, and then we have a decline on Thursday. That's not definitive bearish price action. Coming over to the equal weight, let's look at the S&P 500 on an equal weight basis. And when we do that, as we previously discussed, it's been in this trading range, for a couple of months, probably just a touch over a couple of months now. And you'll see prices have been consolidating along these rising moving averages. And when we get these sideways consolidations within a rising trend, they often resolve to the upside, like we've just seen in the financials, that we had this sort of condition and it went to the downside. But I find that over time, more often than not, they resolve to the upside. It just shows nothing happens all the time. And you can see an example of this back in here. You can see this example from 2024, consolidation in the moving averages, and then we saw upside from there. Of course, prices can break down as well. So there's always, so we're always watching for signs of failure, and we're always managing risk. But I think the default position remains bullish until this structure changes. And at this point, the structure remains positive in the equal weight, which gives us that gauge of the broader broader S&P 500 population, not just the magnificent seven, those top level stocks. Just looking at this week's price action, the equal weight it's rallied off the 100-day moving average, and it's now mid-range. It has pulled back on Thursday, but still around that mid-range point. I think the rally off the moving average this week, I think that's been positive, and it keeps the bullish potential intact. The key for re-engaging the trend is a breakout above these October highs. You can see these highs from October. That's what I think we need to see the equal weight break higher, to see that broad participation in the market break higher, and to then potentially get that sustainable re-engagement of the upward trend. Until then, I think we should expect more consolidation within this range. But I think I still think it's with a bullish bias. I want to show you an indicator quickly. This is the percentage of Russell 3000 stocks above their 100-day moving averages. We've been looking at this a bit recently. What we have here, we've been discussing this declining trend in stocks above their 100-day moving average, and this has been pointed to the current consolidation. We've seen this weakening of the broader market over the last couple of months, and sure enough, it's led to that consolidation. This week has been interesting in that the indicator hit a low of 42%. So only 42% of the Russell 3000 stocks were above their 100-day moving average early in the week. And then quickly, it's lifted by 10 points to 52%. I think it's too early to call this a lasting reversal, but it's encouraging to see an increase in the number of stocks above their 100-day moving average. I think the key to ending the current consolidation is to get this indicator back above its own moving averages, and then should it do that, well then it's telling us that there's that greater participation. We're seeing more stocks above their own 100-day moving averages. I think that's what's needed for a breakout in the equal weight. Let's see whether this can build upon, or whether there's more chop. But I think this is that key. It's encouraging we've had that lift through the week. I've got a graph I want to show you before we finish this section, and it goes back to 2012. It came up on my Twitter feed during the week, as I thought it was interesting, worth having a look at. Comes from these guys called the Market Stats. And so what this is showing? This is showing the percentage of bearishness according to the American Association of Individual Investors survey. The percentage of bearishness. So a high number means there's a lot of bears. A low number means everyone's pretty much bullish. And so it goes back, as I say, to 2012. And what's interesting here is I'm looking at 50%. So this is where things currently are. It's currently was actually 49% according to the latest survey. 49% of survey respondents are bearish. And what's interesting is that you look at other readings where you have about half the market being bearish when the market is near all-time highs or nearest highs. And actually, let's just go through and look at other instances where the market gets to 50%. And often you'll see that this 50%, you can just pause this and go along slower. It's often associated with 50% readings are often associated with markets which have already started to pull back, or markets which are down near their lows. Just go along and look at this. These 50% readings, they tend to be associated with low points. One exception was during 2013. There was a high bearish reading, and the market was near its highs, and the market continued up despite the bearishness. And now here we are here again. Prices near their highs, and there's 50% bears. And so, as I say, 50% bearish readings tend to occur after declines or around the lows, not near the highs. So we've got this interesting situation playing out at the moment. Of course, anything can happen this time, but it seems less likely, to me at least, that a big decline is going to start when so many people are already bearish. So it's an interesting study or an interesting consideration of sentiment, how this is going to play out. Just coming back briefly to the S&P 500, and I think further consolidation looks likely in the near term. Maybe there's a retest, or maybe even there's a break of last Friday's low. That I think that's certainly within the parameters of a normal pullback. But as it stands, I think the odds still favour a bullish trend, not a bearish turn. So let's see how this week delivers. And it's certainly interesting times given the sentiment, and comparing the sentiment to the price action. Okay, so I'm going to jump to the small caps next, and we're going to move on to gold, copper, oil, got uranium in there, got all your stock codes to have a look at. And but of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come in. Doesn't cost you very much. You can get a whole lot of information for the little bit of money it costs to put all this together for you. All right, let's move first to the Russell 2000.